The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. My name is Charles Ostroff. I'm the Chief Credit Officer here at Arbor. We'd like to thank you for joining us today for the webinar. I'll be moderating today's webinar, everything you need to know about small multifamily lending. But before I introduce our speakers, there's a few housekeeping items I'd like to go over. I'd like to let everyone know the webinar is being recorded, and the recording will be emailed to all attendees later this week. We will also have time for a quick Q&A after the presentation. So please submit any questions you have in the Questions tab of your webinar control panel at any point during the presentation. If we are unable to get to your questions, just give us a call or shoot us an email. So let's get started. I'd like to introduce our speakers for today. Dustin Pavir, who is Vice President of Operations and Processing and has been with Arbor since 2008. Thanks for joining us, Dustin. And also Michael Nolan, Originator Sales Associates, who joined Arbor in 2004. I'd also like to welcome Michael to the panel. I'd like to give a brief introduction of Arbor. Arbor, for the last 9 years, has been a top 10 Fannie Mae lender. We've also been one of their leaders in the small loan space. Also, 2015, which was the inaugural year of the Freddie Small Balance Loan Program, Arbor was the #1 Freddie Small Balance Loan lender. Just a little background, and Dustin, can you introduce our guests to our experience within the two programs and our two lending partners?
Sure. Thank you, Charles. So as we can see on this slide, Arbor's two primary small loan products are the Fannie Mae Small Loan and the Freddie Mac SBL. Both of these loan products are geared towards market rate multifamily financing, and each agency has a slightly different criteria or box in which they will consider a small loan. So for Fannie Mae, they consider any loan amount up to $3 million, nationwide being a small loan. They will go up to $5 million in select strong markets, which are New York, LA, Chicago, San Francisco, etc. Freddie Mac, on the other hand, will actually go up to $5 million nationwide and even up to $7.5 million in select top and standard markets, provided a property meets certain affordability calculations. So the long and short of it, Fannie Mae generally up to $3 million across the country, Freddie SBL up to $5 million across the country. And then we can just see here, a few bullets. It just really shows the growth of the small loan market over the last 5 or 6 years. And Arbor certainly has been very active in that space, as Charles alluded to in the previous slide. So, Freddie and Fannie both have, slightly different programs. So the next slide here that we're going to go into just kind of illustrates where both agencies can be competitive and how Arbor takes advantage of that, right? So this map here, we see a few states shaded here in dark colors, which indicate Arbor's most active small loan markets: California, Texas, Florida, North Carolina, and New York. Now, California and New York, for example, are really examples of where Arbor does a fair amount of business in top markets. We're very active around New York City, also LA. Both agencies in recent years have made efforts to really tailor their small loans to compete with local banks in some of these top markets, like Los Angeles and New York City, for example. Now, on the other hand, Texas is a very big market for Arbor, but Texas is generally a nationwide or standard market with some smaller, more tertiary markets as well, where Arbor does quite a bit of business as well. So, if you look at this map, over the last 12 to 18 months, Arbor has closed a small loan in pretty much every state in the country. So, we're very active, obviously, in these certain states, but really across the entire country in this small loan space. So, a few benefits of small multifamily loans, right? Number one here, non-recourse, right? The agencies, Fannie and Freddie in the small balance space, offer non-recourse financing, right? Meaning no personal liability to the borrower. Most banks are generally doing recourse financing, so agencies are definitely a little bit more attractive when it comes to that.
If I can jump in here, These programs offer prepayment flexibility. So traditionally, these small loans would have yield maintenance, which basically would lock a borrower in for, essentially the entire fixed rate term. It'd be very expensive to prepay. But Fannie Mae or Freddie Mac through their SBL program, and now Fannie Mae on properties with less than 50 units offers step-down prepayment. For example, on their 5-year fixed-rate deal, it starts at 5% in the first year, steps down 1% each consecutive year. So it's like a 5, 4, 3, 2, 1 prepayment, giving borrowers the option, to either refinance or potentially, if they go to sell the property, they can get out of that loan fairly easily. So they've brought a lot of flexibility to the programs in recent years.
Sure, yeah, absolutely. And another big question that we see a lot is the availability of interest only, right? And both Fannie and Freddie will allow for partial term or even at times full term interest only, depending on a property's location and the leverage and the term, and we can get into a little bit more of that as we work through the presentation here. But interest only is definitely something we see a fair amount of. In addition, reduced fees. The small balance loans generally are going to cost about half of what we would typically collect for a conventional Fannie Mae or Freddie Mac execution. So fees are going to be less, and kind of segueing here into expeditious processing, right? As Charles alluded to, Arbor was the #1 Freddie Mac SBL lender in 2015. We've been a perennial top Fannie Mae small loan lender as well. And at this point, we have it down to a science. We know how to get the small balance deals done and turned around and closed in a timely manner.
And one of the benefits that you do have is that we have a small balance team that's
a dedicated set of underwriters that are only doing small balance underwriting. Absolutely.
There's also another thing I'd like to point out here is we've made some developments recently. We've launched a Loan Express platform, which is basically an online system for screening and processing these small balance loans. So everything is automated, and it really leads to faster turn times, and it simplifies the process. It's something we'll talk about later on in the webinar.
All right, and so Dustin, I believe you have a couple case studies for us to go over as it relates to some loans that we've done.
Yeah, absolutely. And this slide here that we're looking at right now, just kind of touches on some of the basics again that we'll see in the case studies. Interest only is available at full leverage, as I mentioned on the previous slide. In terms of maximum leverage, again, it somewhat varies depending on the market where a property is located. But the maximum LTV is generally going to be 80% LTV for an acquisition and 75% maximum LTV on a cash-out refinance. Minimum debt service coverage ratio is generally be a 1.25 debt cover. And as I mentioned earlier, full-term interest only can be available under both Fannie and Freddie, generally at lower leverage, 50, 60% LTV with a debt cover generally around 1.5. So the first case study that we have here is a Fannie Mae small loan refinance in Buffalo, New York on a 32-unit property. Buffalo is considered a nationwide market for Fannie Mae. And as we can see here, this was a $2.67 million loan that provided the borrower with $1.4 million of cash out, and this was done under the Fannie Mae 7/6 ARM execution. And the story that we saw here is something that we see pretty frequently, in that the borrower had owned this property for a while. They bought it in 2009. We had a local sponsor with 30 years of experience in the market, other assets. So we had a good comfort level with the sponsor. And over the course of his ownership here with the subject over the last 7 years or so, he put nearly $40,000 a unit of CapEx into the property to completely rehab the exterior and the interior. So it created quite a bit of value in the process. The $2.67 million loan was more or less equal to about 100% of the borrower's cost basis. But again, there was 7 or 8 years of ownership on the property and a good amount of value that had been created, and we had a local sponsor with a good presence in the market. So this was, and furthermore, the borrower was actually a repeat Fannie Mae borrower. We were repaying existing Fannie Mae financing with this transaction. So that's something that we like to see, and a story that we see quite frequently. The next case study here is for a Freddie SBL execution that we did on a 4-property portfolio in Portland, Oregon. And Portland, Oregon is what is considered a top market for Freddie Mac. And the story here was we had a borrower initially come to us with a refinance on a 42-unit property that was a $3 million loan that provided him with $1.5 million of cash out. That was subsequently turned around and invested into the acquisition of 3 additional properties in the market. And what we liked about this deal was that we had a local borrower, again, who had experience in the market. But this borrower had traditionally been a bank borrower. And, as I mentioned earlier, Freddie and Fannie are really trying to go after some of these borrowers who have been traditionally bank borrowers to show that the agencies really can compete in this space. And in this case, the SBL execution was a very attractive one for the borrower. We did 2 of these deals as 5-year hybrid arms, meaning fixed for the initial 5-year period, floating for the 15 years thereafter. 1 year of interest only was done on the 5-year deals, and then we did 2 of these deals as 7-year hybrid arms, meaning fixed for the initial 7-year period with 2 years of interest only on the 7-year products. But this was just a good example of, we had a borrower who had owned the refinance for 7 years and was able to create a fair amount of value there and take that cash out and put it towards the acquisition to continue to build his portfolio in the market.
So it's also a good example of building a partnership with the borrower.
Sure, absolutely.
All right, Mike, I'm going to put you on the spot here since you're on the front lines every day. You're dealing with borrowers. I know the agency loan process for somebody who just gets into it can be a little daunting, but can you walk us through what they need to bring to the table for someone to have a smooth process?
Right, of course. So the first question we always get from borrowers is, what do we need to get started? So here's a quick list of some of the items we look for, in order to give an accurate quote. The first thing is a rent roll. We look for, to show the unit type, any concessions that are offered at the property, half rents or Section 8 voucher tenants. We'd like that listed so we get a sense of the any affordability restrictions or whether or not the property is market rate. We also look for an operating statement, preferably broken out by month for the last 12 months. We also want to gauge the borrower's experience, so we ask for a schedule of real estate owned, showing the location of the property, the number of units, the length of ownership of each property, just to gauge how experienced the client is. We also ask for a personal financial statement that shows your net worth and liquidity. And then some other items, if it's an acquisition, we're looking for a purchase and sale agreement, or if it's a refinance, we're looking for a cost basis, any CapEx you put into the property, what you purchased it for, when you purchased it, that sort of thing. It'll gauge, how long you've had the property for, and essentially what you've done, how you've operated it.
So, Mike, there's a list of information that's here that everyone on the webinar can see. I mean, if I don't have all this, or some of this is incomplete, am I ineligible? Am I not allowed to get a small loan?
Right, not at all. We're here, if you want to give us a call, we're here to, walk you through the process and really work with borrowers. On acquisitions, a lot of times some of this information might not be available, or if you're looking to buy a property from a mom and pop operator, sometimes they don't have the detailed trailing 12 statement.
And I'll just chime in real quick, on the underwriting side. We do see that somewhat frequently, where we have borrowers acquiring properties where the seller may not have kept, the best financials, or they're tough to get, or maybe they're inconsistent. So, at times we will go to Fannie and Freddie and request waivers or exceptions to, on the lack of operating history. Again, it's most commonly seen in acquisitions, top markets where we have quite a bit of experience in a given area, and generally can get the agencies comfortable with an exception or a waiver in those instances.
So, Mike, there's a push right now for technology becoming part of the lending space. Can you touch upon how technology will make it easier for everyone to go through the loan process?
Right. So I'm sure most people on the call are familiar with the commercials for Quicken Loans online platform called Rocket Mortgage. Like you said, there's a major push to streamline quotes on the residential side of the business. the commercial side has been a little bit slow to adopt technology. But in February, we launched ALEC, or Arbor Loan Express, which is the first online platform for agency loans. So, we're a leader in the industry in terms of technology. Basically, simplifies and leads to a more efficient process for screening a deal, getting borrowers terms, and ultimately, closing loans faster, because that information is easier to process. So you'll see here we have the landing page for arborloanexpress.com. Down at the bottom, you can enter in the loan amount you're looking for and whether or not it's a refinance, or an acquisition.
So, Mike, before you get started, I'm going to interrupt you. I mean, how has this product been accepted in the marketplace? What have the comments been, and how have people been using it?
Right. So it really simplifies the process. We're seeing a lot of direct borrowers who might not have had experience with the agency platform really dive in and cut their teeth with using this system. All of the information that we require, it's very easy to access, and it's been so it's been very well received. Really simplifies what was a complex, sort of opaque process.
Plus, it also, from what I understand, it gets Arbor into the forefront, because all someone, aside from contacting Arbor, can do a search on the internet, and then it pops up.
Correct. So you enter your loan amount, whether or not it's a refi or an acquisition, and the next step, you could either upload some of the diligence items that I spoke about earlier, or you can manually input them to the system. And if you submit the deal within normal business hours, your deal will be screened, and you'll have a soft quote within 3 hours or faster. So it's really expedited the processing time. So the next step, after you submit the deal and it's screened, the ALEC system will generate an application that borrowers can electronically sign and resend to us, at which point we begin processing the loan. And that's where a lot of the benefits to having this online portal can be seen. I just wanted to point out here that it's an online platform, but it's not completely automated. You're still working with live people. On the back end, the deals are still being reviewed by our screening teams up in Boston and New York. There's also a live chat feature. So if you have any questions throughout the process, the deal will come to my desk, or a colleague of mine. We'll be able to answer any questions. You can always give us a call. We'll walk you through, really handhold you through the process. So nothing's outsourced. You're still working with real people. But again, to touch on the benefits of processing, borrowers are given a complete list of diligence day one. All of the documents are in the central location. You can download the forms, fill them out electronically. You can electronically sign and verify all the documents, and then upload them back into the system. There's no need to print really anything. There's also a status bar you'll see up at the top that gives you a live indication of where your loan is at in the process. So it's a fully transparent system. These were basically the two main pain points that borrowers have had, in our experience in the past when trying to get an agency loan done. There's a lot of paperwork involved, and borrowers were, had trouble finding out where they were in the process. So ALEC really addresses both.
And as part of the ALEC system, they don't have to have all the information at once. They can submit it as they receive it or as they get it together.
That's correct. And everyone on the deal team has access to the same information. So if an underwriter has a question on a document, they'll note their question down there, and the broker can see that immediately, or the borrower can see that immediately, and address whatever issue there could be. So in a similar note, ALEC isn't necessarily only for direct borrowers. we've had a lot of positive feedback from mortgage brokers who, for example, might have more than one loan in process with us. It's a good way for them to organize their pipeline. It's a very straightforward system, and one of the benefits they like is that they can give their clients, immediate feedback as to what's needed, what's outstanding, and where they're at in the process.
And I see there's an e-signature line.
Correct. So the documents can be verified. There's no need to print, scan and sign these documents, essentially paperless.
Thanks, Mike. I appreciate that run through on the Alex program. I believe we're at a time where question and answers. We've had a lot of questions come in over the course of the webinar. We're going to try to get to as many as possible while we're going to keep track of time so we don't lose everyone's attention. If we don't get to your question today, you can send an email to email@arbor.com with webinar question in the headline. And one of us will get right back to you. Alternatively, you can always call 844-253-9397. I'm going to repeat that because sometimes I do speak fast. 844-253-9397 to reach someone in our origination staff. Okay, I believe we do have one question. The first question indicates that we mentioned experience requirements. I'm looking to invest in my first multifamily property. Will I be eligible for a loan?
I'll grab this one. The short answer is yes. We see that requests come in somewhat frequently, and the key thing that we really look for when potentially financing somebody's first multifamily property is whether or not that guarantor is local to the market, right? And when we're doing the first multifamily property for a given sponsor, we really want the sponsor to be local to the property, meaning within 100 miles of the subject property. And generally, we're going to look for third-party management as well. Professional third-party management is a very important part of what we look at when dealing with first-time or less experienced borrowers. Sometimes what we see too is borrowers who maybe have experience on smaller properties in a market where they are local to. Let's say somebody's in New York, they own a 20 unit in the Bronx, but they're looking to expand their portfolio, get into some new markets, and branch out into Texas, for example. In that case, again, we will look hard at third-party management if somebody is venturing into a market for the first time. But if somebody has good financial wherewithal and some multifamily experience, the agencies are not afraid to lend in that scenario. But again, third-party management and just an overall understanding of the sponsor's business plan with a given property is key in that scenario.
Mike, I believe I have a question. I think this one is probably more geared to you. Is the ALEC system aimed at eliminating brokers?
No, I'd say that's not the case at all. As a company as a whole, about 70 to 80% of our users are brokers. And as I touched on briefly in the, in my discussion, getting a lot of positive feedback from brokers who, again, use the ALEC system to manage their pipeline. It helps them juggle the few deals they have with us at a time, keep everything, organized and
well, one of the things also, just to expand upon what Mike is saying, is that this is a relationship business. We do acquire a percentage of our business from brokers out on the street, and we're looking for long-term relationships and partnerships. And that's how we move forward, and that's how we sustain our business. Right. Another question has come in. Either one can answer, and I believe Dustin may have touched upon this earlier, but what is the minimum loan amounts under both, whether it's the Fannie or the Freddie program?
So generally $750,000 would be the minimum loan amount. Fannie Mae will actually, in certain instances, go below $750,000. In those instances, though, the loans are recourse. So anything over 750 is non-recourse. Under 750,000, again, for Fannie Mae specifically, would be recourse. Freddie SBL is generally 1 to 5 million. In certain instances, Freddie will consider going down to 750,000. But the general rule of thumb for Freddie SBL is 1 to 5 million.
I'd say Fannie Mae is, in generally, they're more inclined to go below the $1 million benchmark. Fannie Mae or Freddie Mac has had a hard line stance at $1 million in our experience.
Okay, I'm looking at the questions as they come in, so if you lose me for a second, I apologize. One of the other questions that did come in relates to what are you looking for our net worth and liquidity requirements under these programs?
Sure. So this is generally it's going to be the same for both Freddie and Fannie, in that both agencies want to see net worth equal to the loan amount as a minimum, and at least 9 months of P&I for liquidity relative to the loan amount. That doesn't necessarily have to be for each individual KP or guarantor. There are times where we see 2 or 3 KPs that combine to meet the net worth and liquidity requirements. But again, just general rule of thumb, net worth at least equal to the loan amount, liquidity equal to 9 months of P&I.
All right. Another question that came in, and Dustin, I'm going to throw this one back at you. Due diligence, asking what's required. I wrote a few notes, as we know, like a PCA, environmental site assessment, and appraisal.
Sure, right. So with the small balance space, we do a combined physical risk report, which is a combined, what we're, typically for the larger conventional deals, we'll do separate PCA and ESA, environmental and property condition reports. Small balance space, it's combined into one report, and then we're looking for an appraisal report too. And then in addition to all of the other just general due diligence requirements that Mike had touched on in terms of borrower financial statements, property financials, rent roll, REO, those are kind of the big items that we look for as part of the diligence process.
Okay, another question that came in, and I'll touch upon it, is typical closing timeline. What I tell everybody on a typical closing timeline is we can close as fast as you can get us the information. We've closed as fast, I say, as in 2 weeks, and we've had deals that have hung out on our pipeline just waiting for things to come in. Typical timeline would be what, Dustin?
Generally 45 days from the time that we kick a deal off, meaning we have a signed application, we have an application deposit in the door. From that point, we're having a kickoff call where the screening team and let's say Mike signs the deal up, Mike is on the phone, and the underwriting team and our legal folks, we get on a kickoff call to discuss the transaction, set expectations, get an understanding of any timing constraints, and from there we engage third parties, and from there it's, again, as Charles said, assuming everything, all the diligence items come in quickly, we can close it 45 days. I'd say the general rule of thumb, 45 to 60 days.
All right, we're winding down. I have 2 questions that I will take and answer just for the sake of time. Somebody had reached out through the webinar to ask about pre-approval, whether we pre-approve prior to lending or lending on a piece of real estate. And there's no pre-approval. We'll send out an application based upon the minimum information that you would send in, which would typically be income and expense statements, where the property is. It's going to show the occupant vacancy, background on the KP or borrower principal in the deal, and then we would typically send out whether it's a one-page term sheet to get control of the deal or an application, depending on the information that we have to move the deal forward. And the other is somebody asked about preferred markets. As Dustin alluded to, we don't only play in strong markets. Arbor built its business on secondary and tertiary markets. That is why we are one of the leaders in the small loan space. We are not afraid to go into secondary and tertiary markets. We visit every piece of real estate. We go to every market. We look at every market. So there is no just we're going to strong markets. We're going to go look at the markets that people present us, where we can do business and where there is opportunity. What I will say is that unfortunately we're not going to be able to get to all the questions today. I know that some were in regards to market fundamentals. We do have quarterly research series on the small multifamily market. Our quarterly small balance multifamily investment trends reports are produced in conjunction with Shannon Economics and examine trends in movement in cap rates, LTVs, DSCRs, and origination volume. You can find the report at the address below. So we'll also include a link in a follow-up email. Also, we do a blog or a chatter. It's called Alex Chatter. If you're looking for more insights on the small multifamily market, you can go to the Alex Chatter, which has news, research, and insight on the sector. It's at arborloanexpress.com/chatter. And finally, if you'd like to get in touch with the loan officer at Arbor, give us a call at 844-253-9397. And again, if we weren't able to answer your question today, you can send them to email at arbor.com, headline, webinar question. You will get a response from one of us. And finally, I'd like to thank Mike and Dustin for participating, and for everyone else who tuned in on the webinar for everything you need to know about small multifamily lending. This does conclude our presentation.